Hey, in this video, I'm going to talk about dividend options in some of the life insurance. So, policies issued by the mutual or life insurance companies must include a provision that addresses dividends. When a mutual life insurance company has a revenue in excess of the expense, it has a surplus. Some of the surplus is used for contingency reserves, some for the working capital, and some is given back to the policy owners in the form of the dividends. So, basically, those when you buy the life insurance, most of the time it's a whole life insurance. If it's from the stock company, so there's no dividend there. That's called non-participating. So when you buy life insurance from the mutual company, so you are called participating because the mutual life companies is owned by the policy holders. So that's why they paying dividends. So when you paying these dividends, there's many different ways to tax the dividends, how to use this dividend, right? So there's a tax implication coming with those dividend options as well. So here we're gonna talk about 5 common dividend options. First is cash option. Second is reduce premium. Third is accumulated at interest. Fourth is paid up dividend additions. Fifth is 1-year term. This is also known as the fifth dividend option. Okay, let's look at the cash option. So basically, the cash options pays the dividend to the policy owners in cash on the policy anniversary. If there's any divisible surplus credited to the policy, the insurance company pays the dividend to the policy owners by direct deposit or check. So it is considered a return of the premium and it is not taxed. So you can see if you take the cash dividend, you are not taxed. So that's something you want to know. This is better than invest in, like mutual funds. When you invest in mutual funds, they have a dividend, you will be taxed. Second is reduce the premium. So when the reduced premium option is selected on the policy anniversary, the premium will be reduced by any dividend paid whenever the dividend exceeds the premium due. One of other options is used when with the balance. Okay, so yeah, basically said, well, if your dividend greater is more than the premium, so you can take a cash dividend or you can use the premium, excess premium to use other option. We're going to talk about it. Simple example, say Steven has a whole life policy for which the annual premium is $1,000. He uses his dividend to reduce his premium. This year, his dividend is $275, so he only pays out of pocket is $725. So this is reduced premium. So again, cash. When you take the cash dividend, because the cash is return of the premium, so it's not taxed. One thing keep in mind is MAC. MAC is a modified endowment contract. I have a video regarding the MAC. So if your life insurance considered as a MAC, if you take the cash dividend, your cash dividend will be taxed. So that's different situations there. Then for the reduced premium, this is similar to the cash dividend. There's no tax due. However, if your life insurance is a MAC, then you use reduced premium, you still be taxed on the dividend. So that's just be careful, because if the MAC is a different situation. The third dividend option is accumulated interest. So accumulated interest, so basically is kind of like a saving account. The insurance company holds the dividend in the separate account and pays a current rate of the interest on the accumulated dividends. At death or on surrender, this fund is paid out in addition to the other policy proceeds. While dividends on participating policies are generally not taxable as income because they are considered a return of the premium, the interest earned on accumulated dividend is taxable. So you can see here, the insurance company hold your dividend in a separate account, so those dividends will earn interest each year. In this situation, your interest earned so will be taxable each year to you. So that's something here. Then paid up additions. Paid up addition is so it's a small amount of the insurance is purchased at the cash value equal to the dividend without any medical or other underwriting requirement. This small amount of insurance is fully paid. There's no premium due to keep it in force. So this one is like, when you receive this dividend, so you kind of use this small amount of dividend to buy like a single life premium insurance. So it's add up to it, right? So this is the paid up addition. So as with the cash value of the basic policy, the cash value of the addition paid up insurance increase at the guaranteed interest rate credited to the rest of the policy. So your cash value will increase as you use this paid up option. So this paid up addition generates more dividends. All of the growth of this dividends is tax deferred. So dividend on the dividends, right? With most companies, the use of the paid up addition option provides for the greater long-term increase in the death benefit cash accumulation. The extra cash value created by using the paid up addition usually exceeds the created by the accumulating dividend at the interest. So you can see here at the beginning, if you buy a whole life insurance, at the beginning your cash value is quite low. So you may not get that much dividends. However, later in your later life year, cash value getting bigger, so then you may get more dividends. So the dividends, then you use this paid up addition. So it's dividends earn dividends. So kind of it's I guess it's a really great way to increase the cash value of your policy. So again, accumulated at interest, so your interest is taxable every year to you. Paid up addition, so return of the premium is not taxed. So this one actually, if you have a MAC as life insurance, you can use this option because you are not going to be taxed if you use paid up addition. The last one is 1 year term. So this one also called a fifth dividend option. So basically, say a policy owner may elect to have the annual dividend to buy a 1-year term insurance. This option will allow for a small dividend to buy a much larger of the death benefit protection. Yeah, because you buy the term insurance. Term insurance, is you use a small amount of the premium, then you get a larger death benefit. Let's see an example. That's no tax to you as well. Let's see an example here. Say, assume you have a client who owns a modified premium whole life insurance and has recently taken a large loan against the cash value. She is aware that the death benefit payable to her husband, who is so beneficiary of the policy, will be reduced by the amount of the loan, and ask you whether she can preserve at least a portion of the original death benefit. So the policy is participating policy. So you have to know it's a participating policy, which means it's from mutual company, right? It's very important. They are from mutual company. So if they are not participating, so then they won't have those options. So what's the best option for the client to choose? Then the things that she wants, kind of have a little larger death benefit. So here you can see the fifth dividend, which is 1-year term, will be better option because her goal is to preserve some of the death benefit. So reduce paid up insurance option. It's you can buy a little additional insurance that will increase your cash value, but your death benefit will not increase significantly, probably increase a little bit, but is compared to 1-year term, is much smaller.